One of the most challenging and complex issues facing our clients when trading across the EU is when they are part of a supply chain that involves 3 or more parties. Often this can lead to multiple VAT registrations across the EU, and with that comes its own complexity in managing the VAT compliance requirements. Depending on the member state concerned, this could be standard VAT return EC sales Intrastat lists, or in other jurisdictions, this can then extend to e-reporting, real-time reporting and SAFTI files. This is even further complicated by the fact that our client's SAP system is not flexible to deal with all of these different challenges and issues. My name is Michelle Lang, and today I'm joined by my colleague Christina Cawley, a senior manager in our consulting team, and Owen Rogers, a director in our tax technology team, who have been working with our clients for many years in helping them understand all of the various VAT issues and helping them report those transactions through our Meridian solution in SAP. Christina, if I can first come to you, perhaps you could talk us through some of the VAT complexities and challenges around chain transactions.
Sure, thanks, Michelle. So from a VAT perspective, a chain transaction, or a drop shipment sometimes as they're known as, is when a seller in one country is selling goods to a buyer typically located in a different member state. They will source the goods from a third party who will ship those goods directly to the final buyer. They can do that for various different reasons. It could be cost saving to purchase those goods from a third party, or they may not have the goods in their warehouse. And this introduces complexities from a VAT perspective for several different reasons. The transaction from a VAT perspective has 2 different transactions in the chain. So one from party A to party B, and another from party B to party C, with those goods going directly from party A to party C in the chain. The complexity arises due to the fact that only one transaction within that chain can be assigned the transaction with transport. And that's important because from a VAT perspective, you can then zero rate that supply as an intercommunity supply. The other transaction within the chain will then be a domestic transaction with local VAT charged. So in the slides we have here, we have a Belgian company selling goods to the final buyer who is located in Poland, and the goods are being sourced from a third party located in Germany. So the goods are going directly from Germany to the buyer in Poland. And as you can see, the transaction between party A and B, this is the zero-rated supply because party A in this chain is arranging for the transport and they're directly sending the goods to party C. Now, from party B's perspective, this means that they need to VAT register in Poland and charge local VAT in Poland. So it's very important to assign the correct transport leg in the chain, or it can cause complexities in terms of where you need to VAT register.
Thanks, Christina. I think it really demonstrates the difficulties for clients in understanding where exactly they would need to be VAT registered. But of course, we know that there is a simplification called triangulation, which would remove the requirement for businesses to VAT register once certain conditions are met. Perhaps you could take us through some of the conditions around triangulation and what businesses need to be mindful of.
Sure, and maybe just as a brief explanation of triangulation. So effectively, triangulation is where you have 3 parties located in 3 different EU member states, and those goods are being shipped directly from party A in the chain to party C in the chain. And effectively what triangulation will do is it will allow party B not to have to VAT register in Poland. So in the case before that we've seen, party B had to register in Poland and charge local VAT. In this case, what triangulation will do is allow party B not to have to VAT register, and they can treat that as an intercommunity supply from their country of establishment, so in Belgium in this case. As you said, there's lots of different conditions. So one of those is that party B cannot be established in the country of arrival. Party A and party B need to arrange for the shipment of the goods from the first party in the chain. So if the buyer actually goes and collects those goods, triangulation cannot apply. And also there's various different country-specific conditions. So some countries will not allow party B to be VAT registered in the arrival country, and others will. So there's lots of different complexities around the conditions for it to apply, and it can lead to a lot of confusion for different businesses.
Okay, thanks, Christina. Owen, maybe if we just have a look maybe at how Meridian would manage the triangulation simplification for our clients.
Sure, absolutely. So As you both mentioned, there is quite a lot of complexity around chain transactions and drop shipments, especially when you bring in that triangulation simplification. And standard SAP doesn't really have the flexibility to understand all of those different conditions that you've explained. So we've tried to bring that into our solutions to make that full process automated. So what we're going to do here is create the example that Christina has shown. So I've got my Belgian selling organization here. I'm going to sell goods to my customer in Poland, standard rated goods. And importantly, I'm going to use a plant that is belonging to an intercompany partner in Germany. So why is that important? SAP will only ever take the departure country as the country of the plant. So in this scenario, when I use a German plant for both the commercial and the intercompany invoice, the departure country will be triggered as Germany. So that means we don't have the flexibility to use the triangulation simplification where, in this case, for party B, the departure country should be Belgium. So that means that you're already creating errors with the standard SAP scenario because your Intrastat and your EC sales are also affected as well as your VAT treatment. But when we trigger this transaction and go into the condition record, you'll notice with the Meridian condition record that's been determined, there's quite a few differences compared to standard SAP condition records. Now, the parameters are still the same. You've still got departure country, destination country, customer tax class, and material tax class. But as you can see here, the departure country has been determined as Belgium, even though the plant is Germany. That's because within our code, we've been able to identify that this is an intercompany partner sending the goods on our behalf to our customer. So therefore, we now have 3 parties in the flow. We've then checked all of the countries that are there. We've got Germany, Belgium, and Poland. So that means we've got 3 European countries, 3 EU countries. And once those conditions have been met, we then start to look at all of the other rules around triangulation. Like you mentioned, where is my selling organization registered? Are they registered in Poland? In this case, we are, but we know that in Belgium, you're still allowed to use the triangulation simplification if registered in country C. If, however, this was Austria, for example, they wouldn't allow that. So all of those conditions have to be understood. For the destination country, we use the EU simplification in our condition records. That means when we're selling to an EU country, we will just create this condition record once because the same tax code will be determined for this condition. But importantly, you'll notice that the customer tax classification has been updated for this transaction to a T to indicate triangulation. That's not hard-coded into our system. This customer does not have that in their master data. They'd have one liable for taxes. But for this transaction, because of all the conditions that we spoke about, they have been met. Therefore, we know triangulation is allowed. It's been activated in this system in the Meridian tables. So therefore, when triangulation is allowed, we want to use it. So this condition record will point to our tax code for triangular transaction from Belgium. And therefore, we don't need to do any manual work here. The sales processor doesn't need to understand triangulation rules. Everything is done automatically in the code in the background. And that's how we simplify the process and get around the inflexibility of SAP.
Okay, thanks, Owen. And Christina, you mentioned earlier on just around the use of the simplification, and it doesn't apply with customer pickups. So perhaps maybe you could talk us through some of the issues that might arise from a VAT perspective when the customer is actually picking up the goods.
Yeah, absolutely. It's a really interesting point, Michelle, because it can completely change the VAT treatment of the supply chain. So in the first example that we talked about, company B in the chain had to VAT register in Poland and charge local VAT in Poland. In the case of a customer pickup, that's basically just the customer picking up the goods physically from either the supplier or the intermediary seller's warehouse and bringing back those goods to their premises. And effectively what that means then is that company B in the chain will need to be VAT registered in Germany in that case. So depending on the conditions for the intercommunity supply to their customer company C, that can either be an intercommunity supply, provided that they have the documentation to prove that the goods have left Germany, or they will have to charge local German VAT. So again, it can add serious complexity because company B may not be registered in Germany and they will have to VAT register in Germany in order to cater for this customer pickup. So it adds a lot of complexity.
And of course, the issue around documentation in terms of proof that the goods have left. So it can be difficult for clients in terms of understanding if their customer actually has proof in order for them to exempt the sale. So can you maybe talk us through how we deal with the customer pickups?
Yes, so one of the things you mentioned about the documentation to prove goods have been taken out of that jurisdiction, there's no indicator in SAP to show that documentation has been provided. So customers need to decide what default setting they want. Do they want to charge local VAT when the customer picks up the goods, or do they want to trust that those goods will be taken out of jurisdiction and documentation would be provided at a later date? The safest option is obviously to charge the local VAT and then at a later point credit that transaction and do a new one for the EU simplification. looking at the transaction we've just created here, if I go back into the sales order, one of the key parameters that our customers use to indicate when a customer is picking up the goods is Incoterms. So for example, FCA or XWorks Incoterms would indicate that the customer is actually picking up the goods. Now, we do have other customers that would use shipping conditions or route, for example. And in our Meridian tables, it's completely customizable per customer as to what indicator they want to use. But once that's been determined in the system, so we'll say in this system, I've indicated that if the Incoterms are XWorks or FCA, I'm going to assume that's a customer pickup. So when I update this order with that, you can see here the freight is redetermined. And when I go back to the condition record, it's quite different, the treatment that we see. So immediately we can see 19% VAT is charged here. And in the condition record, you'll notice that we no longer use the export taxes sequence, but indeed the domestic taxes one. And that's because My Belgium Selling Organisation, who is party B in this transaction, is registered for VAT in Germany. So because the goods are being picked up there, we are now buying locally from our intercompany partner in Germany and selling with domestic VAT to our Polish customer, because we don't know if that export documentation is going to be provided or the documentation to prove the goods have been taken out to Poland. In our system, I have a setting to say, that's the way I want to treat these transactions. But if for certain customers I decide, look, they always provide this documentation, I trust that that will always be the case, we can change the setting to say local VAT will not be charged in this case. But of course, triangulation can still not occur in that case. Even though we're assuming the goods are going to Poland, we still have to have a local purchase from our intercompany partner in Germany. So all of those things are considered. And again, all I did was update one parameter in this order, and you'll see we've got a completely different redetermination of VAT. And that means that there's no manual input from anybody. Everything's happening in the background, and that automation is really the benefit that Meridian is bringing to our customers.
Okay, thanks, Owen, and thanks, Christina. I think it really highlights the challenges and complexities that businesses have in terms of firstly understanding the VAT rules and indeed the simplifications, but then being able to have a system that's flexible and robust, automated solution where they're not reliant on their users being VAT experts. That's it for today. If you'd like further information on the Meridian solution, please contact meridianglobalservices.com.